All right. So just to summarize it all in terms of what you guys have learned, so yesterday, basically, yes, we discussed about the macros, and there was a question about how, the relationship with the TOX with the bond and the dollar index with the pairs, and what does it do. And so basically I said, okay, your homework is to research, and then you're going to present it today, because sometimes basically in class I love to do that in order for also, at the end of the day, you're no longer basically a student. You're also basically going to be a teacher, because one day you'll be teaching this, and it's also important to keep practicing how you can express yourself and how you can communicate it to someone else simply in layman's terms that is purely objective and they can basically understand. Um, so the dollar index, basically, after it was started, actually started in 1973 through Woodman or something like that. Woods.
Wooten?
So,
Bretton
Wood.
Woods?
There you go, Bretton Woods. And prior to that, gold was the major currency that was being utilized because it has a lot of value. And so they got rid of gold, and they said, okay, what if we, now that we have money, in actual fact, if you watch the history of money, that would be awesome, because before currencies have been created, or before even gold, depending on where you're at basically in the world, like in uh, when the Spaniards actually went to the New World was mainly Mexico, further down south, and then before North America was actually found, they were using within the mines and stuff, they were using cacao beans as a form of a trade. And then before, they're not really trading currency, they were trading whatever you may have. Okay, have chickens, but you have corn. Okay, so let's trade. So these are the old ways of trading. And then it was utilized because cacao beans are they're limited, they're very expensive, so they use that. But these ignorant bloody Spaniards, they thought that, oh, they're nothing, so they just basically throw them out actually in the ships and stuff. But nevertheless, the cacao was was a used a form of currency. And then gold became a major thing because the mines had a lot of gold, right? Because they're, for them, that means something and it has a lot of value. They took it basically to Europe, and then that's how they wiped out actually the whole basically the whole Mayan clan, basically, just because of gold. But nevertheless, they got greedy, and then through there it became more of like a currency. Gold, then you have silver, then you have copper as a major currencies for buying things. And then after that, money came into power. And if you read The Creature from Jekyll Island, so smart people, which is the top 1% of the whole world. So in terms of the rich people, they got together, they met at Jekyll Island somewhere in Georgia, and they made basically this idea that if they open up a quote unquote a banking system where they can create print money out of thin air that doesn't have any value. I reckon it's brilliant, like in terms of the idea. And they convinced basically Congress, they convinced the government to do that, and then basically said, okay, let's get it done. And hence that's why the Federal Reserve is a separate entity with the government. And then so basically from there, they have to think of, okay, it's a piece of paper, but how can we value that piece of paper? And so at the beginning, it was backed by gold in terms of your money. This is why if you put your money in the bank and say something happens, then at least you're backed by gold, and you're gonna get the gold if they went bankrupt or something like that. And so in the end, it's no longer backed by gold, but they need to find a way to evaluate the US dollar based on purchasing price index, which is the PPI. What is the purchasing price index? It simply means this in terms of inflation, deflation, or whatnot. So if I go through the whole, simply here, the whole chart of the dollar, the US dollar. So when it started, it actually started at zero. Basically, zero meaning the valuation actually is 100 base, like 100 in terms of the valuation of it. It's a one-to-one relationship, meaning that if it's a one-to-one, if I'm going to go to say to Europe and I want to buy 10 apples for $1, then my $1 will be worth as well €1 in terms of the valuation of it. So it's a one-to-one relationship. However, but because of inflation and different components of the markets or whatever the value would be, then it will change. So prior to the euro, the Deutschmark was one of the highest valuation compared with the US dollar. Why? Because Germany was a powerhouse in terms of its economy. And then when East Germany basically fell and they agreed with the West, and the wall broke down basically in 1989, the economy of the East wasn't really that good. And so to form one government, they decided, in actual fact, the West shouldn't have done that. They should still make it separate because the economy of the West, of Germany, was so good because of, not just technology, basically car industry, all these things, right? The economy of Germany was actually so good, and so they sort of like felt sorry for these Germans, and hence they need to find a way on how to make one currency. And so they spoke with the rest of the European Union that created the European Union and said, hey, what if we combine everything to create one currency? And that's how the euro got created. I believe that's in the 90s. So I still remember that even before I was trading. But nevertheless, I think there's like 24 countries, and the UK was one of them, even though all the economies are separate. But then the UK started to get out of the European Union, even though they said, okay, but the pound is going to the pound. And this is where the Brexit simply happened. It's been a few years now, it's still going on, and hence that's why the pound has its own mind at this point in time. So, but nevertheless, in 1973, they got together, okay, what are the key currencies that are gonna be added to have a value of the US dollar that will create a one-to-one relationship? And so they said, okay, the euro, which is the highest weighted mean, that's a 57.6% because of the other countries as well. Oh yeah, and remember when Greece economy actually basically failed, and then all of a sudden Germany was supporting it, because if not, Greece will go down basically the drain. Without the other weighted in terms of other countries, Greece would have basically plummeted, and that was a big issue also in the past. So, but nevertheless, you have the yen and the pound and the Swiss franc. Then you have the loonie, which is the Canadian dollar, and then you have the Swedish krona. Why Sweden? Well, we're thinking maybe because of IKEA, that's one, because of Volvo, that's two. So those are just the two major ones anyway, or what Sweden can basically provide. I don't know what the rest is. And then of course with the Swiss franc, you have gold because of, in actual fact, I mean, I'm not gonna go into politics, but a lot of the Nazis basically hid their gold in Sweden because, Switzerland, because Switzerland is a neutral country and no one is allowed to touch, actually during the war, no one's allowed to touch Switzerland. So that's basically part of the history. Since you are British there, am I right in terms of Switzerland there for a second there, Yax? Because it's a neutral country. So nevertheless, how is this related to the purchasing price index? Well, if it started based in zero in 1973, then at one point, this is not right, because I know the highest, okay, yeah, I went to 132. Okay, let's discuss here in the year 2000 here for a second. So if it's a one-to-one relationship, and let me put the annotation tool here. If you're gonna put your money in the bank, say in US dollars, say you have $1 million US, you deposit that money in the bank in the year 2000, that valuation of your $1 million is worth how much do you think? 1 million what? 200,000, okay? Because $1 US is equivalent to 120, 100 to 120, right? So 1 to 1.2. So that's the value of $1 million in the bank. Now, if you go, say, to Europe in the year 2001, and I'm going to compare this, okay? So you'll see here, I'll click compare, and I will add that with the euro at this point. Is a euro US dollar here for a second. Okay. So notice that in the year 2001, the value is it's the inverse relationship. It was worth 85 cents per $1 US dollar. So if you're $1 million that's worth 1.2 in terms of valuation, you go to Europe, you can stay in a 5-star hotel because the value of your money is worth more than the value of the euro dollar. Does it make sense? Are you guys following me here?
Yep.
Okay. Perry and Trump?
Yeah, it makes sense to me.
All right. And then notice here in 2008 where the financial markets basically tanked because the mortgage-backed securities. The value here was at what price? The low was 73.56. Therefore, your $1 million in 2008 is worth $730,000. But you're saying $1 million. So that's definitely, it got devaluated right there by a quarter, 25%, more than 25%. Now, if you go to Europe, you're not going to stay in a 5-star hotel, not like in 2001. You'll be staying in a hostel, backpacking, maybe in a 2-3-star hotel because it's too expensive. Why? Because your value of your money is not worth more than it used to be. So you're not going to be eating lobsters and oysters and steaks here. You'll be going to McDonald's because it's the cheapest you're going to get while you're traveling. Make sense? Okay, so that's how the dollar index is created to find the valuation of the US dollar based on inflation, deflation, or what we call the purchasing power of parity. Sorry, not purchasing price index, not PPI, it's PPP. So the purchasing power of the currency. Okay, so by you having the purchasing power of parity, parity is equal. So by you having that currently, what is the value of the dollar index? Well, the value of the dollar index right at this point in time is at 90.432. So right now in 2021, currently at this point, the value of your $1 million is at $900,400. That's the value of it. It's almost a parity. Well, at one point it went to parity, I believe in 2000 something here. Yeah. 2016, there's one in 2020 almost within that high right there. Yeah, there. You went above parity. So if you go to Europe last year in March before the pandemic, man, that's the best time to go. Right now, is it really a good time to go? Maybe not. I mean, it's almost close to the valuation. You'll maybe stay in a 3-star hotel. You'll still be budgeting basically your money because your valuation is not worth that much. So how does it also work? Well, if the value of your money is not worth more, and let's discuss about economy here for a second. Now, if the value of the dollar is not worth more and you're not also increasing your wages, and all of a sudden farmers are going to increase their crops because seedlings is also increasing because everything is just getting too expensive. So by the time they sell their crop from a manufacturing to a wholesale to the wholesaler, it's going to increase in price. The wholesaler will sell it to the retail price to the retailer will also will increase. So if you notice at this point in time, you're going to the restaurant, it's not like it used to be. It increased basically in price. I can't believe, like, I went out last week. It was a beautiful day. I ordered salmon salad. It costed me $20. That used to be like 10, $12. And then some businesses will add in already the tip in there just to cover whatever expense is going to be. So if a normal worker and they're not getting an increase in wage, are they going to support local businesses? Will you really buy? If say you're earning, say for argument's sake, $5,000 a month, they'll make it 10 grand a month to make it easier. But everything is getting too expensive. Your wages are not going, they're not increasing. It's still $10,000, and the company is not giving you, and it should supposedly from 10 to 15 just to cover the same in terms of standard of living. That's why the state of California alone, a lot of people are leaving because everything is getting too expensive, like in terms of even rent and food, and there are no jobs. So if there are no jobs, how can you support local businesses? You can't. That's why businesses are currently shutting down. So the question is, if that's happening, then how come that the markets are still going up? Is it because of, well, it makes sense, which technically, like in terms of the stimulus package and to help people out, they're not helping local businesses. Who will get the money first? Big corporations, just to fuel what's happening, right? And that's why if you notice, the tech companies are going up, and actually McDonald's got a lot of money, but it was basically who gave, what's the something steakhouse, so they got $20 million from the first time in terms of stimulus. That ain't cool. So that's why the big corporations are getting the money to inflate, and hence that's why the stock market is also going up, which actually makes sense. So, but nevertheless, that is within what the dollar index and basically what it does a little bit more in detail. Any questions based on that?